Welcome to CFA Level 1, Derivative. Derivative consists of two study sessions. Study sessions 48 and 49. In the derivatives market, it is a contract between parties whose value is based on an underlying asset such as index, commodities, bond, etc. And generally, there are four types of derivative instruments. Both future and forward contracts are agreements to buy or sell at a specific in the future. However, a forward contract is a customized contract agreed by parties, and futures contracts are standardized contract by the exchange. Swap is a series of forward contract, and option is buying the right to buy or sell. In the derivative instrument, it consists of forward commitment and contingent commitment. Forward commitment is an obligation contract, and therefore, the long or buy side in the future, forward and swap contracts are obliged to buy the underlying asset. Meanwhile, for options and CDS contracts, the long side or buy side, they have the options to buy or sell. For example, if the value in the option contract does not generate positive value, the option holder most likely will not execute the right to buy or sell. The derivative instrument also varies in how it is being traded in the market. It can be a standardized contract trade in the exchange, or a customized contract that traded over the counter. Credit default swap, also known as CDS, is like an insurance payoff, where the holder earns a return if the underlying stock does not fulfill the obligation. CDS and option are contingent claims. This slide is to highlight the advantages and disadvantages of the derivative instrument. In this corn's forward contract, it is a customized contract between farmer and animal feed manufacturer. Farmers can reduce its risk by having the corn price predetermined. The manufacturers can more easily control the raw material cost, corn, when used in producing the animal feed. Here, the forward contract would define forward contract price X and delivery of corn Y months from now. In the forward contract, it could be exposed to default risk. As in the previous example, farmer or animal feed manufacturers might default the contract if the corn price is extremely high or low. The forward contract also can be defined in the interest rate. In the 3 times 9 FRA, it is 3 months from now, to borrow or lend at X rates for 6 months. The forward contract also can be applied to hedge the interest rate risk. In the 3 times 9 FRA, it is 3 months from now, to borrow or lend at X rates for 6 months. Farmers or the animal feed manufacturers can trade corn futures to eliminate the default via a clearinghouse. By trading at the exchange, the default risk is eliminated. The futures contract consists of an initial margin that set the amount needed to trade contract. Maintenance margin, represented set the equity portion required. And variation margin, represented an additional amount needed to bring it to the initial margin. The future exchange would set a price limit in the future contract, and required daily settlement. This slide is to compare forward contract and future contract. This slide is to compare a futures margin with stock equity margin. B is incorrect, because the initial margin is at most 10% of the future price. C is incorrect, because it requires it to back to the initial margin for the futures contract. For equity stock, it is to back to the maintenance margin. Swap is the exchange of payment for another form of payment. For example, in the plain vanilla interest rate, it is to exchange a fixed rate for a floating rate. An option is the form derivative instrument, where the holder has the right to buy or sell. For the right to buy, it becomes valuable when the market price is greater than the option's execution price, which also means the option holder can buy lower than the existing market price. For the right to sell, it becomes valuable when the market price is less than the option's execution price, which also means the option holder can sell higher than the existing market price. To obtain the option, one's need to pay option premium. Exercise price represents the execution price for the options, and moneyness describes the option's value. The call option has a positive payoff when market price S is greater than exercise price X. a call option holder can buy lower. A put option has a positive payoff when market price S is less than exercise price X. A put option holder can sell higher, the long call, where the call holder owns the right to buy. In contrast, the short call sells the right and obliged to sell at strike price, K. When share price S is greater than the strike K, profit increase for long call, and profit decreases for the short call. The difference between the payoff off curve and profit curve is due to the option premium, the long put, where the put holder owns the right to sell, while the short put sells the right and obliged to buy at strike price, K. When share price S is less than the strike K, profit increase for put call, and profit decreases for the short put. The difference between the payoff off curve and profit curve is due to the option premium. The option has two types of value, the intrinsic value and the time value. Intrinsic value is due to moneyness in the option. Time value is due to the validity of the option, and option has greater volatility than the underlying share price. Put-call parity defines the relationship among call price C, put price P, strike price X, spot price S, duration of option T, and risk-free rate R. And rework the formula will get us the synthetic option position. In this practice problem, recall the put-call parity, and rework the formula. This slide is to highlight how different factor would impact call and put options. For example, an increase in the underlying stock would increase the call value, and decrease the put value. Welcome to CFA Level 1, Derivative. Derivative consists of two study sessions. Study sessions 48 and 49. In the forward contract initiation, the value of the between the long side and short sides are equal, in which, holding the forward contract FP is equal to the spot S plus carrying cost minus the carrying benefit. Carrying benefits represent the benefit of withholding the underlying asset. In this slide, it is to illustrate how the T-bill would change in value over. At the initiation, the long and short positions have the zero value. At the initiation, the long and short positions have the zero value. At the end of the contract, the value of the long side is simply the street minus FP. This slide is to illustrate forward contract on dividend stock. In the equity-based forward contract, it consists of dividend, which is the carrying benefit. Therefore, the forward contract would need to deduct the present value of the dividend. This slide is to illustrate forward contract on a coupon bond. In the bond-based forward contract, it consists of coupon interest, which is the carrying benefit. Therefore, the forward contract would need to deduct the present value of the coupon bond. This practice problem is to illustrate how the value of forward price and value of the long position swap contract is to exchange of payment. And again, the plain vanilla swap is to exchange fixed for the floating interest rate. The value of option pricing, it is based on the probability to value moving up U, and the probability of moving down, D. We would use an example to illustrate the calculation. So, the option has upper and lower values are 12.5 and 8, using the previous formula, and the potential value for the call options are 2.5 and 0. Apply the formula. We can also calculate the risk-neutral probability. In the same example, the value for the call is 1.33,